Good afternoon and welcome. I'm Cynthia Cruz, a partner at Evershed Sutherland. Thank you for joining us today for our webinar. We'll be taking a practical look at managing an SBIC after the licensing process is complete. If you weren't able to join our webinar earlier this month on the SBIC licensing process, the recording and the transcript are available on our website. Interest in the SBIC program remains strong, and many platforms, especially those with existing investment vehicles or BDC affiliates, are focusing on understanding the operational steps that come next. Today, I'm joined by my colleagues, Sarah and Paige, who will walk us through our top 10 questions on obtaining SBA leverage and key leverage terms, the portfolio investment requirements and limitations, and important operational and compliance considerations for SBICs. Our goal is to provide practical guidance on issues we see most often with newly licensed funds. So let's start off with obtaining leverage and key leverage terms. What is the process like for obtaining leverage commitment from the SBA? Paige, actually getting the money?
The most important part. After the SBIC is licensed, the next step is to submit a commitment application to request leverage in order to make investments. During the commitment application process, and even now, as we'll discuss during the final license application process, the SBIC requests a total amount of funding to be provided by the SBA, which is based on the SBIC's regulatory capital. The total intended leverage commitment is what's disclosed to the SBA as what the SBIC views as the amount of leverage it will use over the life of the fund, whereas the commitment application process should be requests for smaller pieces of that total intended leverage commitment. And in our experience, the SBA will expect that you're requesting incremental portions of that total intended leverage commitment over time, rather than submitting a commitment application for the entire pie at the outset. And in terms of timing, as we mentioned, the SBA will consider a commitment application now at the final licensing stage, which kind of helps speed up the process for SBICs so that they have debentures available to make investments once they're operational. And as part of the commitment application process, there's legal documentation required to be submitted, bank information, administrative items that the SBA will need in order to actually fund the debenture requests. And the commitment application process also involves an investment plan. So in our experience, it's helpful to make sure that the amount of leverage that you're requesting at any given time aligns with the investment plan that you provide to the SBA, showing that you have the business opportunity to spend the money that they're providing to you.
So you can do that now simultaneously. So once you get your license, you'll be ready to go.
That's right. Now at the final license application stage, the SBA will concurrently consider your commitment application so that you have the debentures available to draw down on once you're ready to start investing.
Right. And that commitment is just the SBA's commitment for the debentures. When you actually want to draw down, that's a separate process.
Exactly. That's exactly right. In terms of timing, the debenture requests themselves come after the SBA guarantees that commitment, and the SBA accepts those drawdown requests twice per month. So it's a bit more of a cyclical timing than the commitment application itself. There are clearer deadlines for when you submit those debenture draw requests.
And then when can you access the money and how soon?
In terms of timing, once the commitment application is granted, those debenture requests can be submitted on that twice per month cycle. But practically speaking, SBICs are limited to half a tier of leverage until they're examined by the SBA. So in our experience, it's helpful for SBIC clients to proactively request to be examined by the SBA earlier on in their operations so that they're able to get past that hurdle, move beyond that half tier of leverage, and access the full amount of leverage that they're able to obtain over the life of the SBIC fund.
And when you do a drawdown, you need to have a reason for the accessing the money, right? But if a transaction doesn't go through, or you don't have to time that, you just keep that money, right?
Exactly, that's right. The SBA, when you draw down on the funds, is looking to see that you have concrete examples of investment opportunities. They want details even up to whether it's an initial investment or a follow-on investment. So they're very focused on making sure that there are actual investment opportunities you have in your pipeline. But as you mentioned, if it falls through, you won't necessarily be faulted, but they are looking for that level of detail at the outset when accepting and approving those draw requests.
Okay, great. So Sarah, what are the terms of the leverage that the SBA is providing today?
Sure, and I'm going to speak to the standard debenture program, which is a traditional SBIC fund, so debt funds that are primarily making debt investments. A couple of things to highlight here. There are some leverage limits. I won't go into the 150 million leverage limit, but to the extent there's a family of funds with SBIC, so two or more are limited to 350. So your ability to draw on your leverage is going to be limited by that 350 cap. In terms of interest rate, the standard debenture is a 10-year term. It's unsecured, and the interest is payable on a semi-annual basis. And the interest, the pooling or the interest rate is pooled on a 6-month basis on March and September of every year, and is based on the 10-year Treasury rate plus the market spread. So as of the most recent one was all in was about 4.532%. So Treasury rate plus a 5 basis points spread on top of that. In addition to the interest payment, there's also an annual charge that the SBA is based on the leverage commitment dates, which Paige was describing right now. So once you get your leverage commitments, the annual charge is based on that date. As of fiscal year end 2026, the annual charge is 25 basis points. Separately, for prepayments fees, to the extent you prepay the debentures after year 6, there won't be any prepayment penalties. But if it's prepaid after the first year, there's a 5%, and each year it goes down by 1%.
Well, and you mentioned the pooling. How does that dovetail if you're taking down kind of on a just-in-time basis the leverage, but there may not be a pooling? Do you look back to the previous interest rates during that gap in time?
Exactly right. And there's a temporary interest rate that you're using at that point until such time that there's a pooling. So if you're at May, you would use that temporary rate on a look back basis, and then at the September pooling date, you would adjust as needed.
Okay, great. Are there additional leverage considerations for SBICs that are part of a larger platform?
So to the extent you're an SBIC is wholly owned by another parent fund, like a business development company, the SBA is very focused to assure that there's collectability on the leverage commitments. And so they've developed standards or rules of thumbs over time to ensure that. So what they're looking for, again, assuming you're going for the full 87.5 leverage, they're looking for the BDC, for example, to have at least 6 times of that total funded capacity. So that gets you around 525 million. So what they're looking for is the BDC will be typically limited to single tier of leverage until its regulatory capital is paid in. So again, they're looking to ensure that the SBA they're ensuring that the BDC parent would be able to cover the debentures for the SBIC subsidiary.
And I mean, and the percentages are the 10 times that type of what you've just talked about. That's moved around a bit depending on kind of what the environment's like, right? And
there, I should mention that there is a separate clause where the SBA has discretion that they want to ensure that they're comfortable with that there's sufficient liquidity. So we've seen it in some instances, depending on the financial operations of the BDC, for them to request more leverage. We've seen them request less. So there's been instances where a private BDC or non-traded BDC was able to, without an inflow of capital, be able to satisfy this requirement. But there are various considerations that you would have to think through.
Right. The SBA wants to be satisfied that you're going to have the financing in place, whether that's debt or equity or however you intend to, and you're going to spend quite a bit of time and probably spent time during the application process, but it's ongoing. So when we can move on to portfolio investment limitations, Paige, what are the definitions for small business? And remember that everything you put into the SBIC has to be a small business.
Exactly. So the definition of small business is businesses that have a tangible net worth of less than $24 million and average after-tax income for the prior 2 years of less than $8 million. And you can also rely on a separate industry size classification standard if those tests aren't met by the particular business. And that test is based on the number of employees or the average annual receipts for whatever industry that business is operating in. And the SBA publishes that information. And there's a separate requirement in addition to all the businesses needing to be small businesses in the SBIC's portfolio, which is that 25% of the SBIC's invested funds have to be in what the SBA calls smaller enterprises. And those are companies that have a net worth of less than $6 million and average after-tax income for the prior 2 years of less than $2 million. And there's an important distinction between these two definitions that the SBA, in our experience, has focused on in exams, which is that small businesses, or everything that's in the SBIC's portfolio, relies on tangible net worth, whereas the smaller enterprise test relies only on net worth. So it's important to think through those details when you're keeping records for the various investments that the SBIC makes, because it's something the SBA has become more focused on in recent years. We formerly weren't even certain that they were aware that there was the difference in these two tests. Just in our experience, it hadn't come up, but in the past couple of years, it's definitely something the SBA has been focused on. And when factoring in these different calculations for small businesses, there are a couple of things that we see come up that can trip people up in defining what is or isn't a small business for the SBIC's portfolio. One is affiliation. Both of these tests take into account not only the business itself, but also the information for any affiliates of the business. And that definition is very broad. It focuses on not just whether another entity controls that business, but whether they have the ability to. So if there's any other entity that has the ability to control the business in question, even if it's not being exercised, the SBA will view that as an affiliate relationship, which can lead to some unexpectedly large businesses in cases where you might not think that the portfolio company would fail the definition. For example, if the small business is owned by a private equity firm, that's a time where we see this issue come up a lot. Another consideration in terms of calculating small business is even if the business satisfies the size criteria, it might not necessarily be a good fit for the SBIC. We've seen the SBA ask questions about why a business had negative average annual receipts. So even though it technically satisfied the definition of small business, it might not have been the type of business that the SBA was hoping that the SBIC would invest in. And then, as we've mentioned, the tangible net worth versus net worth distinction is another obstacle that comes up a lot in making these calculations.
When you're trying to do these calculations, you got to be careful if you've got any kind of complex security or goodwill or various things. And to the extent that you've got a business you're trying to qualify, you need to make sure that you've spent some time looking at those financials and you're comfortable. So just going on to other limitations beyond the small business on the types of companies an SBIC can invest in, Sarah?
Role and before I get into describing those various limitations, I think this is one area that it really highlights the benefits in making sure that the organization has some sort of investment checklist or some compliance mechanism in place to make sure that the deal team is tracking and confirming, as well as the items that Paige just highlighted as well, to make sure that it truly is an investment that is eligible for an SBIC. There are several types of businesses that the SBA would view as ineligible, and I won't touch on all of them, but I'm going to touch on highlight the ones that come up most frequently, and keep in mind that there are some limited exceptions that I'll again briefly touch on as well. The first is re-lenders and reinvestors. So this is referring to businesses whose primary business activity is purchasing debt obligations, for example, or doing some other long-term leasing of equipment, as another example. One exception that the SBA has recently adopted is to allow for equity capital investments in re-lenders that are disadvantaged businesses. A few years ago, this was a major focus, and the SBA was very mission oriented in terms of these sorts of investments. The definition of disadvantaged businesses is very vague. It's primarily focused on ensuring that the business is owned or controlled by individuals that are deemed to be hampered by social and economic disadvantage. Again, very vague. So it's a limited exception that we oftentimes don't see being utilized. The second example of an ineligible investment is passive businesses. So the SBA is not looking for the SBA to make investments in companies that don't have actual operations or employees that are effectively doing the day-to-day obligations of the fund. There are two key exceptions that are often utilized. The first one being if you set up an investment, make your investment through an SPV, as long as the proceeds of that your funding is going through to a small business, that is permitted. The SBA used to limit this to 2 tiers of SPVs, meaning there could be only 2 SPVs below the small business, or sorry, above the business. But they recently removed that limitation on the 2 years, and as long as the proceeds are flowing through to a small business, that's appropriate. In addition, for SBICs that are wholly owned by a business development company that's regulated as a regulated investment company, the SBA does permit equity tax blockers to be put in place to prevent any bad income flowing through to the business BDC. Again, this was a very recent change. Up until very recently, that was not permitted, and oftentimes resulted in the SBIC not being able to participate in equity tags, or to the extent there was a co-investment, the SBIC would have to forego the entire investment because they couldn't participate in the equity position given the same security requirement. Moving on, there's one other requirement I'm going to just quickly touch on is foreign businesses. Again, the SBA is focused on small businesses in the United States. So you'll want to carefully look at to see where the business operations of the fund are, where are the employees sitting, and where's the funds being used substantially for U.S. operations. So again, that's a requirement that oftentimes comes up. There's a couple other exceptions, but those are the kind of the key ones that come up on a day-to-day basis.
And then are there overline limits as well?
Yes. So
go ahead.
Yeah, so the SBA is also looking that you may not invest more than 10% of your total capital in any single company. So what does that mean? That means you're looking at your private capital plus your total amount of leverage, projected leverage. So again, assuming you're going for the full 87 and 87.5 leverage commitment, so 2 tiers of leverage, you're talking about 30% of your private capital. So they want to ensure some level of diversification in the portfolio. So that is one thing that you would need to look at the outset as well.
Yeah, and if you have 2 SBICs, you have to aggregate those. So if you've got a family of SBICs, you need to be very, very careful about that. So some other operational and compliance considerations. Just what's the reporting the SBIC requires to be made to the SBA?
You'll have an annual audit that's separately provided to the SBA. There's valuation reports, and I'll touch on the valuation. I'll pause and talk about the valuation reports as well. The valuation, the SBA has a very specific valuation guidelines that they expect that is followed here. So to the extent, again, you're an SBIC that's wholly owned by a BDC parent or another parent fund, there will be an instance where your valuations of a single investment at the SBIC level is going to be different than what's presented on the fund level. So there effectively would be 2 sets of books for the SBIC and the parent fund. In addition, you'll need to present a report with respect to each financing that discloses how you complied with a small business test. And separately, the SBA does do examinations. There been a big push in recent remarks. They've made a comment that they're striving to do exams on an annual basis.
Right. So some of that paperwork you're required as a fund to keep yourself. Some of it gets submitted. But I mean, as far as the paperwork that goes into an application is very heavy. When you get further down, it becomes much lighter, and it's much more of a regulatory environment where you get examined, and that's when they go and do deeper dives. Is that the way to look at it?
Right. In terms of the actual reporting to the SBA, it is lighter, and oftentimes, given that the forms are often a little archaic, you have third party vendors that are engaged to kind of assist in terms of compliant inputting the information to the specific forms, but much lighter load after you've completed the MAC.
Because the SBA has its own accounting or reporting rules there, which are not GAAP. So that's the Paige, can SBICs co-invest with their affiliates, kind of across the platform or with other funds?
Yeah. Practically speaking, there are two types of associate-related transactions that the SBA is focused on. The first is financings with an associate, so what we would think of as typical co-investments. And they're also concerned with financing an associate itself. So I'll focus on that first one, financings with an associate. The general principle governing both of these types of transactions is that SBICs can't make investments that would create a conflict of interest. And in the SBA's view, investments with an associate do not create a conflict of interest if the investment is made between the SBIC and the associate on the same terms and at the same time, in addition to on the same conditions. So outside of those cases, the SBIC would need the SBA's prior written approval to engage in that co-investment. Practically speaking, this often means that the co-investments just aren't feasible if they can't be done on the same terms or at the same time, because the timing of the closing of the investment can't necessarily be slowed down to make sure that the SBIC makes it through the pre-approval process in time, especially when there are other features of the transaction that might be outside the control of the SBIC and its associate. So these types of investments really highlight the importance of having a strong relationship with your analyst. Being able to get their attention on something quickly and get feedback is a helpful way to get through any prior approval process. And in our experience, it's also helpful if there's sort of one person who can be the center of communication between the analyst and the SBIC management team, so that in instances where you do need a quick answer, even though it might not be guaranteed, that kind of puts you in the best position possible if you're in a pinch and would need prior approval for those types of transactions. In terms of the second type of conflict of interest transactions that the SBA is concerned with, the SBA is also focused on instances where the SBIC might be providing financing to a business that is itself an associate of the SBIC. And this is only permissible in, again, certain circumstances with prior SBA approval. We often see this come up when an associate of the SBIC has made a previous investment in a business, and because of the SBA's look-back rules, that business ends up maintaining its status as an associate of the SBIC even after the associate that might be on the same platform as the SBIC has divested itself from its interest in that business. So the business in question could still be considered an associate of the SBIC even if it's been a few months since the associate divested itself, which is why in our experience, it's very important to nail down these details at the outset of an investment and carefully consider the associate definition, especially the look-back rules when considering a financing.
And if you're a part of a BDC type platform or regulated platform, and you've got exemptive relief from an SEC, does that allow you to forego the SBA rules?
It does not, unfortunately. It's just another layer of consideration in these types of transactions and doesn't separately guarantee that you'll be able to make these investments between the SBIC and its associates.
Great. Okay. And Sarah, I think we're actually up to our number 9 of our important items. Is are there other scenarios where the SBIC is going to need to sign off, or you're going to need to interact with them?
There's a few, and they're more major transactions in the SBIC that I'm going to highlight. The first one being a change in principle. So to the extent a new principle is being added to the investment committee, or an individual has departed, that's going to require prior SBA approval. Again, the SBA is going to require the same level of detail and information that was previously provided in the MAC. And they've provided a letter will need to be included that provides additional details around the change of management as well. In addition, a change in ownership. So if there's 10% or more of the licensee has been has been sold, but there's not a change in control, this would require SBA prior approval. This is typically, if you fit into this kind of definition, it would constitute some sort of form of a letter to the SBA. Again, the key here is to highlight that there's no change in control. And highlight the facts of the transaction. And the last one being a change of control. So if there's a change of control, that's going to be a very detailed deep dive by the SBA. As you know, when you went through the MAC application, they're vetting your management team. So to the extent there's a change of control, it's going to result in a change in management. That's going to be a very detailed, extensive review by the SBA. So just like life, though, the most important thing to do here is to be a good communicator with your SBA analyst. Paige said it very well. Have an open channel of communication with your analyst. You, to the extent the information, you want to ensure that you're communicating to your SBA analyst before it becomes public, and well in advance. So typically when we see larger M&A transactions that involve a change of ownership of the SBIC, this is a closing condition that could take some time.
Yeah, and if just to go back for a second on the principles, if you one, you always have to have two principles. If you don't, that can create some issues on taking down additional leverage. But the actual approval for a new principal is the same as what you'd go through when you're going through the licensing. You've got to go through the background checks. You've got to do fingerprints. So it is not a quick process. So to the extent there's a change going on, being prepared ahead of time is, I guess, our best guidance, because that does take a little bit of time. So we talked about getting the money into the SBIC. How do you get the money out? Or are there any limitations on how much money you can take out?
In terms of the wind down process, the SBA is focused on that exact question, what your plan is to pay back the debentures, and other details like your liquidation timeframe for each investment and anticipated proceeds. And depending on how early you're paying back the debentures, there are different form requirements for what the SBA will expect in terms of the information you're providing them on timing, your other investments that are expected to mature at that time, things of that nature. So the wind down process is almost equally as involved as operating the SBIC more generally. And back to the communication with your analyst point, it's very helpful to have a clean line of communication with them so they can convey their expectations. The format for the wind down plan is not necessarily as formulaic as other aspects of operating an SBIC. So it's another aspect where communication with your analyst is really important, so you're providing the correct information when they expect it.
Right, and one of the things just to keep in mind is that the SBA is not a bank, so they're not going to want you to be paying back your the debentures or trying, and then as almost like a revolver. This is a long-term kind of relationship. And then on the distributions, as far as if you're not, it's not a wind down, but if you're just distributing back up the dividends, you have to meet the REIT test, and so there's certain limitations around that. Anything else you guys want to add for today?
Yeah.
You covered it. So I think that we're coming to the end. I would like to say that one of the things you should consider as a new licensee, if you haven't already, is the SBIA is an association of SBICs, and if you want to keep up to date what's going on in the SBA world, and potentially if you want changes or issues arise, they are a great resource. So I would just definitely recommend looking into that kind of a membership, and they're great people to work with. And I will just augment again. You've heard us a couple times talk about the SBA analysts. I would just say you'd like to make them your best friend. So when you call or have an issue, you know who they are, and you can give them sufficient time to react. So, what I'd add to that is you really want one person talking to the SBA. You don't want to have a bunch of different people, and I would actually recommend that that person be one of your principals. So it's and I know that getting time with folks is not always the easiest, but you want to make sure that who's ever speaking to the SBA understands the program and the rules. So Sarah and Paige, thank you for all your insights, and to our audience, thank you for joining us. We hope today's discussion provided helpful practical guidance on managing an SBIC, from navigating the leverage commitment and the draw process to understanding the portfolio investment limitations and key operational requirements. If you have any questions about how these considerations apply to your organization, please feel free to reach out to any one of us. We also encourage you to stay tuned for future programs, and we continue to unpack some of these key issues. And thank you again for joining us, and we look forward to connecting with you soon. Thank you.